Okay, this is chapter 18 homework, and I'm going to apologize right away for the loud noise in the background, but it was the only way that I could get this recorded and out to all of you. So this is chapter 18. There are 9 questions, and I'm going to help you with this homework a little more than usual. I just feel it's important that you have a sense of this material. But keep in mind, you will not be tested on this part for the final exam. But it's useful information. So here we go. Okay, so question number 1 is asking you about what is an import, what is an export, and net export. So we actually have done this previously. So quick reminder, an export is generally considered a domestic product or service that is sold overseas. An import, we usually think of that as an import in, so it's a foreign good or service that comes into the US. And the US net exports would be where we take the difference between the value of the exports and we minus out the imports. So it's exports minus imports. That's what are. Okay, so this question gets even a little bit more detailed though on this information about imports and exports. So I'm going to do the first one with you. So this says, a French historian spends a semester touring museums and historic battlegrounds in the United States. Okay, so this is a foreigner that is here in the US. So the foreigner has come here to study or to tour in this case. And as they're touring, they are spending their money from France here in the United States. So what that means is that's going to cause the exports to increase. It won't do anything to imports in this case because it didn't say anything about any foreign goods or services coming in. Remember, this is the foreigner has come to the United States and is spending here in the US. So they're buying US products. So that's why it's considered an export. And then the US net exports, is the difference between exports minus imports. So if your exports have increased and your imports have not changed, then your US net exports will have to increase. Okay, let's do the next one. Your parents go on a trip to Japan in late March for the cherry blossom season. Okay, so this is the opposite of what we just did. So this is now a US person or family going overseas and they are in Japan spending money. So they're spending US money on Japanese products. So that is going to, with the detail, that's going to be an increase in US imports. Won't do anything from this question to exports. So the net change, which is exports minus imports, here we have exports haven't changed, and then it's minus imports. So your imports have gone up, which is going to make the net exports decrease. So again, the detail of this particular question is just adding on. We usually think of an export as a US good being sold overseas. We think of an import as a foreign good being sold here in the US, but it also takes on the flavor of, a US export is also a foreigner coming here to the US and spending money, and an import is a US family or person going overseas and spending money overseas. So I think you should be okay with the rest of these questions. So we'll go ahead and we'll continue on to question number 2. Okay, this is kind of going along the same way as the first question. So let's kind of quickly do this. It's adding on one little detail, and that's regarding net capital outflow. So we have net exports, which is from the previous question, is exports minus imports, and then we have what's called net capital outflow. And what net capital outflow is, it's just this difference between the purchase of foreign assets by domestic residents, so in this case by U.S. residents, and the purchase of domestic assets or U.S. assets by foreigners. So it's another measure that we use in the U.S. to see what's going on. But in this case, rather than it being goods and services, which is what net exports looks at, net capital outflow is looking at assets being purchased by either overseas, by U.S. Residents, or foreigners purchasing assets here in the United States. So, and what you need to do on these questions is figure out, are these things that are being bought, sold, whatever it may be, are they goods or services, or are they assets? So let's get going. An American buys a Toyota. Well, that's definitely a good or a service. It's a good in this case. So it's going to be some impact on net exports. Let's do the next one. An American fashion company opens up an outlet in the UK. Okay, that's an asset. It's a fashion company. It's an American fashion company opening up an outlet in the UK. So that is going to be an asset. And I'm going to tell you that's going to be an increase in the net capital outflow. A German citizen buys a share of Google stock. Again, that's not to do with net exports. This is an asset. So I'm just going to tell you that's going to be a decrease. And then the last one, a South Korean tourist buys some sun-kissed oranges from an American farmer. Okay, that's a good or service, so it's going to have impact on net exports. So from the previous question, I think you'll be able to do these, the one on the Toyota and the one on the sun-kissed oranges, and we'll continue on. Okay, question number 3. It says, indicate whether each of the following actions represents a foreign direct investment or foreign portfolio investment. So for a quick reminder, a foreign direct investment means that's where we're actively managing an investment. So for example, you buy some manufacturing plant in a foreign country. That's going to be a direct investment. A portfolio investment is considered, I guess they describe it as something that's more passive. So that's going to be like buying bonds or stock. It's not where you have direct, everyday oversight needed. Like when you're managing a manufacturing company in another country, you've got to oversee it. So foreign direct investment would be, owning a plant overseas. Foreign portfolio investment is the type of investment of, buying and selling, I would say, bonds. So I think from that, you should be able to know which one is the portfolio and which one is the direct investment. And then on the true-false question, it's asking you, it says, an individual investor is more likely to engage in foreign direct investment than a corporation. Do you think that's true or false? So if you're just an individual, like just think of yourself, are you going to be more likely to engage in direct investment where you're going to be buying a manufacturing plant and overseeing it on a daily basis than a corporation? I mean, if it were me, I'd be going more for the portfolio. Okay, so we'll continue on. So question number 4 is just continuing on with the idea of net capital outflow. So reminder, net capital outflow is the difference between purchases of foreign assets by, in this case you'll think of by U.S. residents, minus out the purchase of domestic or U.S. assets by foreigners. So it's the difference between the two. And then you're asked about the type of investment that is involved. Is it going to be a direct investment or portfolio investment? So remember, your direct investment is the type of investment like buying a foreign plant overseas, or a foreigner purchasing a U.S. plant here in the U.S. So that's direct investment, and portfolio investment is to do with buying the stocks and bonds. So the way I would approach this question is just quickly go through and figure out, okay, is this an investment? What kind of investment? So first one, an American fast food company opens up a store in Japan. Well, let's just do this. That's definitely a direct investment. Samsung sells stock to a general pension fund. Well, that's portfolio. Sony expands its corporate office in New York. I think you can do that. This one, a Goldman Sachs mutual fund sells its Sony stock to a British investor. Again, that's portfolio investment going on. So what you want to now do is figure out, okay, what impact will that have on capital outflow? So let's just do the first one. So this says an American fast food company opens up a store in Japan. So net capital outflow is the difference between purchase of a U.S. Resident purchasing a foreign asset, minusing out foreigners purchasing U.S. assets in the U.S. So this is an American fast food company opens up a store in Japan. So that's going to make it more positive of U.S. residents purchasing foreign assets, which is the first part of this difference. So it's going to increase our net capital outflow. So you'll just want to approach these questions in that manner. And I think with this guidance, you should be okay. And we'll continue on to the next question. So what is question number 5? Okay. So it says, indicate whether each of the following groups would be happy or unhappy if the US dollar were to appreciate in value. So when the US dollar appreciates in value, what that means is that the dollar is going to be able to buy more foreign currency. That's how you want to think about it. So an appreciation or increase in the US dollar means the dollar will buy more foreign currency. So if Spanish investors holding US government bonds, are they going to be happy with this investment? Well, it's gone up in value is a way of how you could kind of think of this, because the dollar's appreciated. US agricultural industries, are they going to be happy or unhappy? Well, again, the dollar has gone up in value, which means it takes more foreign currency to buy the U.S. currency. So in essence, what that means is it makes U.S. goods overseas more expensive. So if you're the industry, you're not going to be too happy about it. And it seems like a contradiction, but it's not. Mexican tourists planning a trip to the United States. So again, think about this. When the dollar appreciates, it means the dollar buys more foreign currency, which is okay. But for a Mexican tourist coming into the United States, that means their currency will now buy less US dollars. So they're not going to be too happy. And then the last one, an American firm trying to purchase property overseas, they're going to find it wonderful because the dollar has gone up in value, so it buys more currency overseas, so they would be happy. So kind of giving you that one. But take a little bit of time to think this through, because this can become important, especially if you're planning a trip going overseas somewhere. Okay, so we'll continue on. So question number 6. On these, I am just going to go ahead and briefly, I'm actually just going to give you the answers on this, because for no other reason than time. So question number 6, you're going to go ahead and put decreases. So this question is just having us look at, what's the difference between nominal exchange rates and real exchange rates. So your nominal exchange rate is just the rate at which a person trades the currency of one country for the currency of another. So that's nominal exchange rates. And then your real exchange rate is the rate at which a person trades goods and services. So it's goods and services of one country for the goods and services of another. So there's a slight difference between nominal and real exchange. And we'll just keep going. So, and then I'm just going to give you these answers. So just plug them in. The peso dollar exchange rate is going to be 24 in this. And then the next one, suppose a monetary expansion occurs and it causes everything to double in price. Well, it's going to cause the pesos per dollar to then double in price. And the formula that's being used here, and the first one for the peso dollar exchange rate, all we're doing here is we're just looking at the price of the basket of goods from abroad and dividing it by the price of the basket of goods domestically. So just so you know where we're getting this number from, so it would be 42 divided by 175, which gives us the 24. And then here, in monetary expansion of just doubling the money is just going to double that dollar exchange rate. So we'll continue. On this, this is just where there's a formula again that we can use to find predicted exchange rate. And the historical, or I don't know if we call it historical, but the interesting little fact is it's not uncommon to use the price of Big Mac throughout the world as a sense of what's going on with exchange rates. And the reason for that is because McDonald's sells their Big Macs almost in every, well not every, but in many, many countries throughout the world. They've been very successful in entering markets throughout the world. And so they're one company that we can make comparisons with the items that they're selling, you know, overseas really easily because they're all over the world. So the trick to get predicted exchange rate, again, this is just a good little thing to know. It's just a formula. So you take the units of foreign currency per Big Mac, and you're going to just divide it by the price of the Big Mac, which in the US is $4.93. So to get the predicted exchange rate, you would take 7,900, you would divide it by the $4.93, and it should come up to 1602. And you would just go through and you would do that for each one of these. In this case, for Sri Lanka, you take the 350 and divide it by 493. For the one for Russia, you take the 114 and divide it by 493. So I think you can figure those out. And then I'm just going to give you the numbers for purchasing power parity. So the numbers here will be 85, and the number for the euro will be 155. And I'm just going to quickly tell you that the purchasing power parity is this idea in economics that states a unit of any currency should be able to buy the same quantity of goods in all countries. And there's a big assumption here with purchasing power parity. It's assuming the products are perfectly interchangeable, identical, if that's the case, there's no barriers and so forth, then purchasing power parity can hold to be true. But it can be quite difficult to be able to have the precise conditions for purchasing power parity to take place. And then let's see, we have one last question, and I'm just going to give you the answers to this. So we take the price of Spam in Wickham and divide it by the price of Spam in Ectina, and that would be 16 over 2, which gives us 8. And then here, I'm just going to tell you, you're going to put double here, quadruple here, and double here. And then this is, will it be higher? Will the nominal interest rate be higher? In Ecnia, if I'm saying that correctly, sorry about this, it's going to be false. And then down here, the very last part of this question, you're going to put nominal exchange rates adjust for the effects of inflation. Actually, good information to know. So I just want to again remind you, I know I went through this pretty quickly. I just want you to have an overall sense of, you know, what are net exports. They are important for a country. It gives them a sense of, you know, what's going on with goods sold overseas, goods coming into the US. It also gives us a sense of foreigners traveling to the domestic country, and vice versa, US residents going overseas and spending their money in other countries. The net capital outflow is a great thing to kind of again have an idea about, because it's not uncommon these days that pension funds, 401k funds, where they're purchasing, you know, assets, portfolio, stocks and bonds, primarily stocks and bonds, you know, from other countries. But you never know, you might one day work for a company where they're purchasing actual assets, like a manufacturing plant overseas. So these are all important things. And then if you travel, having some understanding of exchange rates can serve you quite well. So hope this helps. Let me know if you have questions. And I think that was it for these questions. Yes.